Take control of your money today with a simple system that removes stress and builds real freedom. This audiobook delivers practical steps to organize finances, automate bills, and turn small weekly habits into lifelong wealth. You'll learn how to track every dollar, design an unbreakable monthly routine, set time-bound goals that actually get met. Expect clear, actionable lessons you can apply immediately, backed by a stoic mindset that sharpens discipline and resilience. Subscribe now to receive each chapter as released and get worksheets, templates, and weekly reminders to keep your progress steady and unstoppable. An exclusive listener Q&A session. Number 1. Track every dollar weekly. Imagine waking on a quiet morning, sunlight folding across a kitchen table cluttered with a mug and a small stack of receipts. There is a small, steady sound as fingertips scroll through a phone app, and a slow, clear click as a spreadsheet cell is filled in. That short ritual, 5, 10, 20 minutes each week, is how control enters the financial life. Tracking every dollar weekly is not about paperwork or accountants. It is about coming home to the truth of your money. It is a disciplined conversation with reality, what arrived, what left, and why it matters. That conversation builds clarity, reduces anxiety, and creates the conditions for intentional choices. Money is a form of information. Without tracking, that information leaks away in a blur. Subscriptions renew unnoticed, small habits accumulate, and months pass without a clear sense of progress. Tracking every dollar weekly turns noise into signal. A weekly rhythm is chosen deliberately because it is frequent enough to catch patterns and errors quickly, but not so frequent that it becomes a daily chore. It fits into a life of work and rest, creating a steady feedback loop. Observe, reflect, adjust. This cadence transforms money from an abstract worry into a set of observable behaviors you can influence. Begin by choosing a simple system. The most elegant systems are the ones that get used. A plain spreadsheet, a minimalist app, or a ledger notebook will all work if the system is consistent. Create columns or fields for date, description, payee, category, amount, account, bank, cash, card, and a short note. Keep categories tight and meaningful. Housing, utilities, groceries, transport, subscriptions, entertainment, health, savings, debt payments, irregular one-off, and miscellaneous. 10 to 15 categories is enough to see patterns without drowning in labels. Labeling is not academic. It is functional. When a transaction lands in a category, it reveals whether the action aligns with your priorities. Set up a weekly routine and anchor it to a real moment in the week. For many, Sunday evening works. The day is quiet, the week ahead is visible, and decisions can be made with a fresh mind. Pick a specific day and time and protect. The ritual should be short and reliable. Open the app or spreadsheet, import or enter new transactions, categorize each item, and reconcile totals against bank balances. If a transaction is unclear, add a short note and flag it for investigation. This is a moment of curiosity, not judgment. The focus is on understanding, not shaming. Concrete steps make the habit frictionless. If using a spreadsheet, create a template that calculates weekly totals by category and a running cash balance. If using an app that syncs with accounts, still do a manual review. Auto-categorization saves time but mislabels often. Use a simple checklist for every weekly session. Import or enter new transactions. 2. Categorize each item. 3. Reconcile account balances. 4. Total each category. 5. Compare to budget or last week. 6. Note anomalies. And 7. Pick one corrective action. That corrective action is the engine of progress. It might be canceling a forgotten subscription, adjusting a grocery plan, or scheduling a call to negotiate a bill. One action per week compounds into meaningful margin over months. Understand the metrics that matter. Track total income, total expenses, savings rate, income minus expenses divided by income, discretionary spending, and number of recurring subscriptions. Watch trends rather than obsess over any single week. If a week spikes, ask why. A spike might be a one-off repair or a creeping habit. The weekly view helps separate occasional storms from steady leaks. Visual cues can be powerful. Simple charts or a column showing percentage change from the previous week turn numbers into stories. The goal is to make the unseen visible so choices become intentional. Accuracy is valuable but not perfection. Avoid the trap of paralysis where the pursuit of perfect labels keeps the weekly habit from forming. If a transaction is ambiguous, assign it a provisional category and flag it for review. Reconciliation, matching the sum of recorded transactions to the bank balance, is the essential discipline. If numbers don't line up, find the gap, a missed entry, a pending deposit, or a duplicate charge. The weekly habit finds mistakes quickly, so errors are small and fixable. Over time, the number of flagged items will drop. The work becomes faster and more fluid. Behavioral change happens through immediate feedback. When you track, the consequences of choices become obvious. That midday coffee habit that seemed harmless shows up as a recurring weekly total. Subscriptions that once blended into the background become visible line items. Seeing these habits mapped to hard numbers removes excuses and creates space for decision. Replace vague intentions with specific actions. Reduce dining out by 1 meal per week. Renegotiate internet service. Or set an automatic transfer to savings the day after payday. Each small measurable change becomes a proof point that discipline works. Design rules that make tracking simpler and protect momentum. A 2-minute rule helps. If categorizing a transaction will take less than 2 minutes, do it immediately. Keep receipts or a photo folder on your phone for anything that requires deeper review. Create a quick capture category for small, unclear items to be processed during the weekly session. Establish a simple naming convention for transactions so searching becomes easy. Vendor, purpose. For cash purchases, set an entry habit. Carry a small receipt envelope or log the expense on the phone immediately. Cash can vanish. A habit prevents it from becoming invisible. Use the weekly session to ask 4 honest questions. Did money flow where it should? Did any recurring charges surprise me? What one change improves next week? What should be automated to reduce friction? Automate predictable, disciplined behaviors where appropriate. Auto pay for fixed bills, automatic transfers to savings or debt, and calendar reminders for the weekly session. Automation and tracking are partners. Automatic transfers ensure savings happen. Tracking ensures those transfers are aligned with goals. Guard automation with periodic review so autopilot does not become negligent. Create a visual financial dashboard that fits on a single screen or page. It should show this week's totals by category, the savings rate, one-line net cash flow, and a snapshot of progress on a primary goal, emergency fund level, debt repayment, or investment contribution. The dashboard is a compass. It tells whether the current course matches the intended destination. Keep it clean. The mind responds to clear, immediate signals more than to long narratives. A tidy dashboard reduces friction and strengthens resolve. Turn small insights into action. If food spending crept higher, plan 1 meal batch cooking session and schedule it. If subscription services accumulate, line them up and decide which to cut. If transport costs spike, compare alternatives. Rideshare versus monthly pass. Driving versus biking. Each decision should be a test. Choose a 30-day change and measure its effect on next month's weekly totals. This experimental stoic approach treats money as the outcome of choices, not the master of them. Anticipate slippery moments and prepare simple guards. For emotional spending, create a cooling-off rule. Any discretionary purchase above a set amount, for example, a percentage of weekly discretionary budget, requires a 72-hour wait. For impulse digital purchases, remove stored payment details from platforms. For recurring bills vulnerable to price creep, put a quarterly reminder on the calendar to review and renegotiate. The weekly habit will surface triggers and patterns. Pre-made rules reduce the need for moment-by-moment willpower. Accountability fosters consistency. Share a weekly summary with a trusted partner, a close friend, or a financial accountability group. If sharing is uncomfortable, keep a private journal of weekly highlights and one action chosen. The act of recording and articulating progress creates a private, powerful contract with future behavior. Stoic discipline thrives on outward expression of inward commitments. Tracking becomes a practice of integrity, aligning intention, action, and outcome. Finally, adopt a long view with short steps. Tracking every dollar weekly is not a sprint. It is a discipline that compounds. The first weeks will feel mechanical and slow. Clarity replaces anxiety incrementally. Over 3 months, patterns become obvious and small corrections grow into new habits. Over a year, the cumulative effect of weekly adjustments reshapes financial reality. This is not about deprivation. It is about freedom, the freedom that comes from knowing where money goes and why, and the freedom to direct it toward what matters most. Begin with a single disciplined week. Choose the day, open the ledger, enter the transactions, and pick one small corrective action. Repeat it faithfully. The sound of a pen on paper, the gentle hum of a spreadsheet recalculating, the brief satisfaction when totals align. These are the quiet rituals of mastery. The practice builds not only a stronger balance sheet, but also a steadier mind. Control the small and the large soon follows. Number 2, automate bills, eliminate stress. Imagine the quiet relief that washes over you when a task that once drained mental energy disappears from your daily consciousness. Bills, for many people, carry the weight of constant vigilance, the anxiety of missing a payment, the stress of juggling dates, and the subtle erosion of mental clarity as small obligations accumulate. Automating bills is more than convenience. It is an act of disciplined foresight that transforms financial life from reactive chaos into a structured, serene rhythm. By setting up automation, the energy once spent chasing due dates becomes available for thoughtful decision-making, creativity, and long-term planning. It is a step toward mastery over time, attention, and money simultaneously. The first step is to inventory every recurring expense. Take a week, or even a weekend, to map out every bill that appears monthly or weekly: rent or mortgage, utilities, phone and internet, insurance premiums, subscriptions, loan payments, and any other commitments that arrive with regularity. Some may be automatic but untracked. These are the silent drainers of attention. Understanding the landscape is essential. Write down each expense, its due date, the method of payment, and the amount. A complete picture exposes not only the obligations, but also the opportunities to simplify. Clarity begins with seeing the whole field. Next, explore automation tools. Banks, credit unions, and online payment platforms offer reliable methods to schedule transfers and payments. Many utilities and service providers allow for direct debit, and apps can track, categorize, and even alert for changes. Choose the systems that integrate smoothly with your financial workflow. The goal is to reduce cognitive friction, not to create a new layer of complexity. Automation is only effective when it reliably executes without intervention. The tools should work quietly in the background, requiring minimal attention while giving maximum peace of mind. The process of automation requires thoughtful sequencing. Begin with the essentials: mortgage or rent, utilities, insurance premiums, and debt obligations. These are non-negotiable commitments that carry consequences if neglected. Set up automated payments on a fixed schedule, ideally aligned with income flows. The rhythm should match your cash inflows. A day or two after paycheck deposits ensures funds are available, avoiding overdraft or late fees. This alignment demonstrates the principle of intentionality, money moving deliberately according to plan rather than reaction. Once essentials are automated, turn to discretionary subscriptions and services. Streaming platforms, memberships, software, and recurring donations often accumulate unnoticed. Automation here should be paired with periodic review. A recurring charge that is no longer used may go unnoticed without deliberate oversight. Schedule a quarterly or monthly review of these automated transactions. The goal is not to eliminate enjoyment, but to ensure that spending aligns with current values and priorities. Conscious automation protects against creeping financial inertia. Automation also cultivates a subtle but profound sense of discipline. Each successful on-time payment reinforces the habit of foresight and planning. Mental space that was previously consumed by worry becomes available for higher-order thinking. Instead of reacting to deadlines, attention shifts to strategy, investing, saving, exploring new income streams, or simply enjoying the freedom of uninterrupted mental clarity. The act of automating bills is itself a practice of stoic preparation, removing distractions to create conditions for calm and intentional action. A crucial element is monitoring. Automation does not eliminate responsibility. It shifts it from reactive vigilance to proactive oversight. Once a week, or at minimum monthly, review all automated payments. Confirm that amounts match expectations, that due dates align with cash flow, and that no unintended charges have appeared. Automation without verification is risk, not freedom. The ritual of review is brief but impactful. It preserves control while maintaining the benefits of automation. This small act of accountability prevents drift and reinforces confidence in the system. Automation also provides an opportunity to consolidate. Multiple payments to similar destinations can often be streamlined. Combining credit card bills onto one payment or scheduling several transfers on a single day reduces complexity and cognitive load. Fewer moving parts translate into fewer opportunities for error or stress. Simplification amplifies clarity. Each decision to consolidate reflects a commitment to mastery over the environment rather than submission to its randomness. Psychologically, automation reduces the friction of small, repeated decisions. Each choice deferred or eliminated strengthens self-discipline indirectly. Impulse, distraction, and forgetfulness lose power when the routine is programmed and predictable. Mental energy, once scattered across numerous reminders and micro-decisions, is consolidated into strategic thought. This is a form of leverage. The system works for you while you focus on creative, meaningful, or growth-oriented tasks. Freedom emerges as a byproduct of intelligent structure. Consider emergencies and contingency planning. Automation must be robust yet flexible. Maintain awareness of cash flow and buffer accounts to absorb fluctuations. Overdrafts or insufficient funds undermine trust in the system and create stress. Stoic discipline entails anticipating disturbances and preparing contingencies. The buffer is not fear, it is prudence. Automation without a safety net is rigid, while automation with planning is resilient. Financial resilience mirrors life resilience. The ability to absorb shocks without losing composure. Automation is also a foundation for scaling financial habits. Once basic payments are automated, attention can shift to more complex strategies, savings, investments, and debt reduction. Automatic transfers to a high-yield savings account or retirement plan exemplify the compounding power of disciplined routines. These automated contributions become habitual and invisible, yet their effects accumulate significantly over time. Money works in the background just as the automation works for your life. The quiet growth of assets mirrors the quiet growth of personal discipline. The emotional dimension of automation is often underestimated. Anxiety about late payments, sudden fees, or missed obligations erodes daily well-being. Automating these transactions transforms that anxiety into calm certainty. The act of setting up automation is a declaration. Life is structured, responsibilities are met, and chaos is minimized. Each automated payment is a small but potent affirmation of self-reliance and foresight. Stress is reduced, not because problems vanish, but because the mind is freed from constant vigilance. Automation invites reflection and decision-making at higher levels. Freed from transactional minutiae, one can ask meaningful questions. Is spending aligned with purpose? Are obligations supporting long-term goals? Can resources be better directed? By lifting attention from repetitive tasks, automation creates the space for conscious choice. Life, once fragmented by small deadlines, becomes a series of intentional actions that contribute to larger visions. Finally, automation embodies the principle of disciplined detachment. Money, once a source of daily worry, becomes predictable and manageable. Responsibility is exercised not through constant attention, but through wise system design. The weekly or monthly review, brief and intentional, replaces daily anxiety with deliberate oversight. The mind, unburdened from chasing due dates, develops clarity and calm, a foundation for resilience in all areas of life. By automating bills, stress diminishes, confidence grows, and the energy once trapped in reaction is redirected toward meaningful, purposeful action. Begin with one bill today, schedule it, align it with income, and watch the subtle relief unfold. Add another the next week, then another. Within a few months, the mental landscape shifts. Chaos gives way to structure. Anxiety is replaced by confidence, and discipline manifests in the quiet hum of automation. Each automated payment is more than convenience. It is a step toward mastery over attention, responsibility, and life itself. The path to financial calm is built one automation at a time, and each step reinforces the principle that intentional systems create freedom. Number 3. Separate spending from saving. Imagine holding your paycheck in your hands, the total figure representing the energy, effort, and time you have invested in your life. That number feels substantial, yet without clear boundaries, it can slip through your fingers in ways you barely notice. The single most powerful principle for creating financial stability and long-term growth is separation, distinguishing between money meant for daily living and money reserved for future goals. Separating spending from saving is not just a practical strategy. It is a mindset, a deliberate declaration that some resources are untouchable, sacred, and dedicated to growth rather than consumption. It is the quiet but profound act of giving structure to your financial life, giving purpose to every dollar, and preventing the erosion of future possibilities by present impulses. Begin by defining what saving means in your life. Savings is not simply leftover money at the end of the month. It is a commitment made at the start, an intentional allocation of funds before any discretionary spending occurs. Establish clear categories: emergency fund, retirement contributions, long-term investments, or specific goals such as travel, education, or a home. Each category represents a purpose, a destination, a vision of the life you intend to build. Once savings has an identity, it gains priority. The act of separation becomes a physical and psychological boundary, ensuring that these funds are treated with reverence, rather than casual afterthought. Practical separation begins with accounts. Do not rely on mental distinctions alone. Human nature struggles to honor abstractions. Open dedicated accounts for savings and keep them distinct from everyday spending accounts. A simple structure might include one checking account for daily transactions and multiple savings accounts, each tied to a specific goal. Digital tools or banking apps can facilitate this separation, but the principle remains: funds for tomorrow must be inaccessible to the impulse of today. Physical separation, or even a clearly labeled digital system, reinforces discipline through clarity. Automate the division. Just as automation removes the friction of bill payments, it enforces the boundary between spending and saving. Schedule transfers from income directly into savings accounts the moment money arrives. Treat saving as the first expense rather than the last. This shifts the mindset from reactive saving to proactive investment in your own future. The action is immediate, deliberate, and unstoppable unless consciously overridden. When money is segregated before it touches discretionary funds, the temptation to spend prematurely is reduced to near zero. Next, define spending limits consciously. Once the saving portion is protected, the remaining balance becomes your operational budget for daily expenses. Be precise about allocations for groceries, transportation, utilities, entertainment, and discretionary purchases. When the framework is explicit, decisions are made with intention rather than impulse. Overspending becomes obvious immediately, allowing corrective actions before habits become entrenched. Boundaries create freedom because choices operate within clearly defined limits, preventing the mental chaos of trying to monitor every dollar without a system. Visual cues amplify the impact of separation. Create a dashboard, chart, or simple ledger that displays spending versus saving in real time. Seeing a line climb in a dedicated savings account while watching spending stabilize in a separate account produces an immediate sense of accomplishment and control. Visual progress transforms abstract numbers into tangible evidence of discipline and growth. Momentum builds naturally as the human mind responds positively to clear, observable results. Psychologically, separation cultivates patience and delayed gratification. Each saved dollar is a small exercise in self-control, an act of resisting immediate temptation in favor of a larger reward. Over time, this practice strengthens resilience, discipline, and foresight. The act of consistently honoring the boundary between spending and saving becomes a character-building exercise, teaching lessons in prudence, planning, and intentional living. Financial maturity emerges not merely from accumulation but from the repeated exercise of restraint and clarity of purpose. Emergencies highlight the value of this practice. A distinct emergency fund is not negotiable money. It is a buffer that allows life to continue uninterrupted when unforeseen events occur. Without separation, emergencies force the depletion of discretionary funds or even savings, creating stress and unplanned disruption. With clear boundaries, however, emergencies are managed calmly. The discipline of separation converts potential chaos into manageable adaptation, demonstrating the power of foresight at tight systematically. Flexibility is compatible with separation. Life is unpredictable, and circumstances change. Goals shift, incomes fluctuate, and expenses vary. Separation does not mean rigidity. It means knowing where each dollar is intended to go and adjusting deliberately when priorities change. Reassign savings goals or adjust spending allocations consciously rather than reacting impulsively. The power comes from awareness and intentional action, not blind adherence to arbitrary divisions. Each adjustment is an exercise in thoughtful control, reinforcing mastery over both finances and self. Separation also allows for more strategic decision-making. When you know precisely how much is available for spending, you can make conscious choices that align with values rather than impulses. Every purchase becomes a decision evaluated against priorities. Will this action bring immediate pleasure, long-term value, or neither? This clarity eliminates waste, maximizes utility, and strengthens the alignment between financial behavior and personal purpose. Money becomes a tool rather than a source of confusion or regret. Consistency compounds results. Treat separation as a weekly or monthly ritual. At the beginning of each income cycle, allocate savings first, then distribute remaining funds according to spending plans. Regularly review balances and progress toward goals, adjusting allocations as necessary. The rhythm of separation, repeated faithfully, produces exponential benefits over time. Small, disciplined actions stack into significant outcomes, shaping a future defined by intentional choice rather than scattered reaction. The emotional benefits of this practice are profound. Anxiety about overspending diminishes when boundaries are respected. Peace of mind emerges from knowing savings are secure and daily obligations are covered. Stress does not disappear, but the mind no longer wages constant battles with itself over every small purchase. Mental clarity increases, allowing attention to focus on growth, opportunities, and meaningful experiences. The discipline of separation creates space for life to unfold with greater serenity and confidence. Practical nuances enhance effectiveness. For shared finances, communicate boundaries clearly with partners or family members. Agree on joint goals, designate accounts for shared expenses, and maintain separate accounts for personal spending and saving. This clarity reduces conflict and ensures that discipline is mutually respected. Regularly reconcile accounts, verify balances, and track progress against targets. The act of reviewing strengthens awareness and reinforces the habit, preventing small lapses from growing unnoticed. Over time, separation fosters a sense of abundance rather than restriction. As savings grow, goals are achieved, and financial stability strengthens, the individual experiences freedom and empowerment. The act of intentionally protecting certain resources teaches a deeper truth. Control over money is inseparable from control over one's life. Financial discipline becomes a reflection of inner mastery, where deliberate choices, foresight, and consistency yield both tangible and intangible rewards. Begin with one simple step. Choose a fixed percentage of income to allocate to a savings account immediately upon receipt. Make it untouchable, sacred, and non-negotiable. Then define your spending boundaries, assign categories, and commit to monitoring them. Repeat this process with each income cycle. The rhythm becomes second nature, a quiet framework that shields you from impulse, strengthens resilience, and nurtures growth. In this disciplined structure, money transforms from a source of stress into a tool for freedom, stability, and purposeful living. The power of separating spending from saving lies not in complexity or restriction, but in clarity, intention, and consistency. Each dollar receives a role, each decision carries awareness, and each week's review reinforces mastery. By respecting the boundary between what is consumed today and what is preserved for tomorrow, life becomes less reactive, more intentional, and ultimately richer. This practice shapes both financial health and character, teaching lessons that extend far beyond numbers. Discipline, foresight, and deliberate action become habits, forming the foundation for a life guided by purpose and resilience. Number 4. Build simple monthly money system. Money is not just numbers in a bank account. It is energy, effort, and intention flowing through life. Without a system, that energy scatters, and even the most disciplined person can feel powerless at month's end. Building a simple monthly money system is about creating a rhythm that aligns income, spending, and saving into a predictable, manageable flow. It is not about complexity or over-engineered tools. It is about clarity, consistency, and intentionality. When a system is in place, anxiety diminishes, decisions become deliberate, and each month transforms into a controlled experiment in mastering resources in life. Start with a clear picture of all income streams. Include primary earnings, side income, freelance work, and any irregular deposits. Knowing exactly what enters your financial system sets the foundation for planning. The system cannot succeed without certainty about inputs. Record each source, its timing, and its variability. Even small, irregular income should be noted. Over time, patterns emerge that inform realistic planning. Visibility of income transforms uncertainty into actionable information, which is the first step toward control. Next, categorize all outgoing expenses. A simple system works best with clear, functional categories. Essential spending, housing, utilities, groceries, transportation, insurance, forms the backbone. Discretionary spending, entertainment, dining, subscriptions, hobbies, needs its own allocation. Savings and debt repayment occupy separate, non-negotiable categories. The purpose of this categorization is to make every dollar visible, accountable, and intentional. By grouping expenses logically, patterns become apparent and unnecessary friction is reduced. Once income and expenses are mapped, assign allocations. This is the heart of the monthly system. Decide before the month begins how much money will go to each category. Treat savings as a first priority rather than a leftover. Automate allocations wherever possible to reinforce the system and remove the temptation to overspend. For discretionary categories, establish limits that are challenging yet realistic, preventing both deprivation and overspending. The discipline of allocation converts financial chaos into predictable, actionable patterns. Timing is essential. Align your system with the rhythm of income and obligations. Weekly or bi-weekly tracking can be added, but the primary structure revolves around the month. At the beginning of each month, funds are distributed according to the plan. This creates a mental and emotional buffer. Obligations are met, savings grow steadily, and discretionary spending is consciously constrained. Timing transforms abstract planning into lived experience, turning the month into a predictable cycle rather than a series of surprises. The system should be visual. A simple spreadsheet, digital app, or physical ledger can display the allocations, amounts spent, and remaining balances. Visual clarity reinforces accountability. When you see the proportion of income assigned to each category, decisions become intentional rather than reactive. Visual cues make discipline easier, not harder. Each check against the plan is a small but tangible proof of mastery and a reinforcement of habit. Incorporate a weekly checkpoint. The monthly plan sets the framework, but weekly review ensures alignment. Check which categories are on track, which require adjustment, and where overspending is occurring. A brief session of 20 minutes is sufficient to stay in control. These small, consistent reviews prevent minor deviations from growing into systemic problems. Weekly awareness strengthens the monthly system and creates an ongoing dialogue with your finances, cultivating mindfulness and responsibility. Automation strengthens the system without replacing oversight. Bills, savings, and recurring payments can be automated to execute on schedule. Automation reduces friction, prevents missed deadlines, and protects priorities. However, automation is not a substitute for active engagement. It works best when paired with periodic review. Automated transfers for savings, debt payments, and fixed bills free attention for discretionary decision-making and strategic thinking. A simple, automated, and monitored system is both efficient and resilient. Flexibility must coexist with structure. A system rigidly adhered to without reflection can become brittle. Life is unpredictable, and occasional adjustments are necessary. Expenses fluctuate, income varies, and unexpected events occur. The monthly system should allow for conscious adjustments, reallocating funds while maintaining overall discipline. This flexibility prevents frustration and ensures that the system remains a tool for empowerment rather than a source of stress. Track trends rather than individual anomalies. Over several months, patterns emerge. Certain categories consistently overshoot, others remain underutilized. Identify these trends and adjust allocations accordingly. This is not about judgment. It is about evidence-based refinement. Each observation feeds back into the system, creating a loop of continuous improvement. The monthly plan evolves from experience, becoming increasingly aligned with reality and priorities. Incorporate goals into the system. Savings should not exist as an abstract figure. It should be tied to tangible objectives. Emergency funds, debt reduction, travel, education, and investments all provide motivation and meaning. When goals are integrated into the system, each allocation has purpose, and each decision reinforces progress. The connection between action and outcome strengthens commitment, making discipline more natural and less burdensome. The system also creates psychological space. Knowing that essentials are covered and goals are advancing frees mental bandwidth. Decisions about daily purchases no longer require constant calculation or anxiety. Energy is redirected from reactive worry to intentional action. Life feels less like a series of financial emergencies and more like a series of manageable, deliberate choices. Mental clarity and peace are direct byproducts of structure. Simplicity is the ultimate sophistication in a monthly money system. Avoid overcomplication, too many categories, unnecessary calculations, or elaborate rules create friction and reduce adherence. Focus on essential categories, clear allocations, and regular reviews. The fewer moving parts that need active management, the more energy is available for strategic planning and personal growth. Elegance and simplicity is not restriction. It is liberation. Prepare for irregularities and unexpected expenses. No system operates in a vacuum. Build small buffers within discretionary categories or maintain a separate contingency fund. When surprises occur, adjust consciously rather than reactively. A robust system anticipates variability and absorbs it without stress. Preparedness enhances resilience, allowing the monthly plan to remain a reliable framework even when circumstances shift. Engage accountability mechanisms. Sharing progress with a trusted partner, friend, or mentor can reinforce discipline. Even self-reporting in a journal enhances mindfulness and strengthens commitment. External or internal accountability ensures that the system is maintained consistently, converting intention into action. The simple act of documenting progress creates reinforcement loops that make the system self-sustaining. Over time, the simple monthly system compounds in impact. Small, consistent allocations towards savings and goals accumulate. Disciplined spending prevents waste and clarifies priorities. Each month's execution reinforces habits that carry forward indefinitely. The predictability and clarity provided by the system cultivate not only financial stability but also character, patience, and self-mastery. The process is iterative. Each cycle builds upon the last, transforming a once chaotic financial life into a landscape of order, freedom, and deliberate choice. Start with one clear month. List income, define essential and discretionary categories, allocate funds, automate transfers, and commit to weekly check-ins. Implement the system with fidelity, observe results, and refine the process. Repetition strengthens habit, clarity enhances control, and intentionality produces results. A simple monthly money system does not just organize finances. It organizes life. It turns scattered energy into structured action, stress into confidence, and potential into tangible progress. Mastery of money becomes mastery of time, attention, and personal agency, one month at a time. Number 5. Create one financial command center. Imagine standing in front of a control panel, every switch, dial, and screen offering immediate insight into the state of your life. Now imagine that panel represents your financial world. Bills, income, savings, investments, and obligations once scattered across accounts, apps, and paper statements are all visible in one place. A financial command center is exactly that, a single organized hub where every aspect of your money can be tracked, understood, and managed with clarity and purpose. It is not a tool for complexity. It is a tool for mastery. By consolidating information, you gain the ability to act decisively, plan effectively, and prevent chaos from seeping into your daily life. The first step is collecting all financial information. Gather bank statements, credit card accounts, investment portfolios, loans, insurance policies, recurring bills, and income sources, physical documents, PDFs, apps, anything that holds data about money flows belongs here. This stage is about visibility. Until you can see the full landscape, control is impossible. Each item is a piece of a puzzle, and only by bringing them together can the picture become clear. Without completeness, decisions are guesses. With completeness, decisions are deliberate. Next, centralize access. Choose a single location to house your financial information. This could be a digital platform, a secure spreadsheet, or even a physical binder if that suits your style. The method is secondary to the principle. Everything must be accessible, visible, and systematically organized. Use folders, tabs, or labeled sections to separate income, spending, obligations, savings, and investment. Clarity emerges not from complexity, but from the simple act of consolidating what was scattered. The command center is a manifestation of order over chaos. Prioritize what matters most. The command center should highlight critical information first: cash flow, upcoming bills, current balances, and pending obligations. Less urgent items, long-term investments, or minor subscriptions remain visible but secondary. By emphasizing what requires immediate attention, mental bandwidth is preserved for real-time decisions. This hierarchy reduces stress and ensures that actions are aligned with both immediate needs and long-term goals. The command center functions as both radar and compass, alerting to threats while pointing toward objectives. Automate updates wherever possible. Banking apps, account aggregation tools, and notification systems can populate your command center with real-time data. Automation ensures accuracy and reduces the burden of manual entry, leaving time for analysis and decision-making. A well-maintained command center is alive, reflecting the current state of affairs without constant effort. Automation complements oversight. It is not a replacement for conscious engagement. The command center thrives on timely and reliable information, which forms the foundation of strategic action. Visual clarity enhances understanding. Use graphs, color-coded categories, or simple tables to display balances, obligations, and progress toward goals. Human brains respond to visual patterns far more efficiently than to raw numbers. Seeing the proportion of income allocated to debt, savings, and discretionary spending immediately conveys priorities and progress. Patterns become visible, anomalies stand out, and decisions are informed by insight rather than memory. The command center translates complexity into actionable intelligence. Integrate recurring obligations into the system. Bills, subscriptions, and loan payments should be logged with due dates and amounts. Include reminders or alerts to anticipate when actions are required. The goal is to prevent last-minute stress and late fees, transforming reactive behavior into proactive management. Anticipation creates calm and builds confidence, allowing life to proceed without the friction of financial emergencies. Each alert is a nudge, each entry a safeguard, and the combined effect is a seamless orchestration of responsibility. Incorporate savings and growth tracking. Your command center should not only track what leaves your hands, but also what is growing or accruing. Emergency funds, investment contributions, retirement accounts, and goal-specific savings all need visibility. Track monthly contributions, total balances, and progress toward targets. When growth is visible alongside obligations, motivation is reinforced and discipline is strengthened. The command center becomes a map of both present stability and future potential, a dual view that combines security and ambition. Plan for exceptions and irregular events. Life is unpredictable, and even the most disciplined systems encounter surprises. Include a buffer section or contingency log to account for unexpected expenses, income fluctuations, or changes in obligations. The command center should highlight potential gaps, allowing decisions to be made calmly and deliberately. Awareness of risks, paired with prepared responses, transforms uncertainty into manageable variation. Mastery is not the absence of surprises, but the presence of readiness. Weekly reviews are essential. A command center is a living system that requires attention, reflection, and adjustment. Dedicate time to reconcile accounts, check upcoming obligations, monitor savings progress, and assess deviations from planned budgets. Identify trends, note anomalies, and plan corrective action if necessary. This ritual is not about perfection. It is about alignment. Regular engagement transforms static information into dynamic insight, reinforcing discipline and promoting continuous improvement. The command center also functions as a decision-making tool. When all information is in one place, trade-offs and priorities become obvious. Should additional discretionary funds be spent, invested, or saved? Can debt repayment be accelerated without compromising essential expenses? The clarity of the command center allows choices to be evaluated quickly, rationally, and in alignment with long-term objectives. It is a practical embodiment of strategic thinking applied to everyday life. Security and privacy are critical. Sensitive information, account numbers, passwords, and personal identifiers must be protected. Use encrypted platforms, strong passwords, and secure backups. The command center should provide control without vulnerability. Peace of mind is enhanced when critical financial information is both accessible and safeguarded. Security reinforces confidence, which in turn strengthens discipline. The integrity of the system ensures that control over finances is not undermined by oversight or exposure. Psychologically, the command center cultivates calm, confidence, and intentionality. When every financial element is visible and organized, mental clutter diminishes. Anxiety associated with missed payments, forgotten obligations, or unclear priorities fades. Energy once consumed by worry is redirected toward creative, productive, or growth-oriented pursuits. Financial clarity produces emotional clarity, and control over resources enhances overall resilience. The command center is a tool not just for money, but for composure and self-mastery. Refinement over time is natural. The first version of a command center may feel rudimentary or incomplete, but it should evolve. Add categories, adjust visualizations, refine alerts, or incorporate new financial instruments. Continuous improvement ensures the system remains aligned with current reality, goals, and habits. A command center is a dynamic reflection of both your environment and your evolving capability, growing stronger as you engage with it intentionally. Integrate accountability mechanisms. Share periodic summaries with a trusted partner, mentor, or financial advisor. If sharing is not desired, maintain a personal log of updates and insights. Documentation reinforces engagement and creates a feedback loop that strengthens consistency. Accountability transforms passive tracking into active management and encourages a higher standard of stewardship over resources. The command center unites strategy and execution. It transforms scattered, reactive activity into deliberate, informed action. It provides immediate insight into cash flow, obligations, savings, and growth. It alerts to anomalies, highlights opportunities, and creates space for calm, strategic thinking. By centralizing information, automating updates, visualizing data, and incorporating regular review, the financial command center becomes a locus of control, clarity, and deliberate action. Begin by consolidating accounts, gathering statements, and choosing a platform that suits both preference and accessibility. Populate it with essential information, automate updates where possible, and set a routine for weekly review. Over time, the system evolves, trends become visible, and decisions become faster, more confident, and more aligned with long-term objectives. The command center transforms money from a source of stress into a structured, reliable, and empowering tool fostering both financial security and personal discipline. Each interaction with this centralized hub reinforces a mindset of mastery. The visibility of obligations, progress toward goals, and overall financial health provides both reassurance and motivation. By engaging regularly and thoughtfully, the command center ensures that no decision is made in ignorance, no obligation is forgotten, and no opportunity for improvement is overlooked. It is the heartbeat of disciplined financial life, a daily practice of control, clarity, and intentionality that underpins both security and growth. Number 6. Use envelopes for smart control. Imagine standing at a table with a stack of envelopes in front of you, each one labeled with a purpose, each one holding a precise allocation of money for a specific category. This simple, tactile method is more than nostalgia. It is a strategic approach to financial discipline. Using envelopes for smart control creates boundaries around spending, makes choices deliberate, and fosters awareness that is often lost in the blur of digital transactions. Each envelope is a small but powerful tool. It defines limits, encourages planning, and transforms money from a fleeting resource into a visible, tangible force under your control. The foundation of this approach begins with clarity. Identify the categories of your spending that require physical limits: groceries, entertainment, dining, transportation, personal care, and discretionary purchases. These are areas where impulses can erode plans and undermine progress. Each category receives a separate envelope, a container for both money and intentionality. By allocating funds in advance, the envelopes establish the invisible boundaries that our minds often struggle to maintain with mental accounting alone. The act of separating funds physically reinforces both discipline and awareness. Determine the allocation for each envelope based on realistic monthly spending patterns. Review past habits, examine average costs, and create limits that reflect both necessity and restraint. Accuracy matters, but so does practicality. Overly strict allocations set up frustration, while too lenient allocations defeat the purpose. The envelope system forces a reconciliation between intention and reality. It reveals where spending habits align with priorities and where adjustments are necessary. Each envelope is a test of self-knowledge and self-control. The process of filling the envelopes is itself transformative. When money is placed into a category, there is a moment of reflection. This cash is dedicated to a specific purpose, and once it is gone, it cannot be easily replaced without sacrificing another goal. The physicality of cash transforms abstract numbers into tangible limits. Handling money in this way builds awareness that digital transactions often obscure. The envelope becomes a teacher, showing in real time the consequences of choices and reinforcing the discipline of restraint. Spend only from the envelope designated for that category. When the envelope is empty, the category is complete for the period. This simple rule creates accountability and prevents overspending. It transforms spending into a conscious decision rather than an automatic action. Over time, this boundary strengthens decision-making skills, instills patience, and encourages prioritization. Every dollar spent is evaluated against both immediate satisfaction and the broader financial plan. The envelope system is a form of structured freedom within limits. Choices are empowered and intentional. Flexibility is embedded within the system. Some categories may require occasional adjustment due to unforeseen circumstances. In such cases, transfer between envelopes thoughtfully rather than borrowing indiscriminately. This maintains the principle of boundaries while allowing for strategic adaptation. Awareness of trade-offs is essential. Reallocating funds is a deliberate act, not a casual convenience. This fosters mindfulness and reinforces long-term discipline, teaching lessons in prioritization and delayed gratification. Track spending patterns visually or in a companion ledger. Each envelope's depletion provides data, which categories require adjustment, which are consistently over or under budget. These insights guide refinement, ensuring the system evolves alongside life's realities. Patterns become visible, and decisions become evidence-based rather than reactive. Awareness of trends enables proactive management and continuous improvement, strengthening both financial control and personal responsibility. The envelope method also cultivates emotional intelligence. Impulse buying is curtailed, frustration is mitigated, and satisfaction is enhanced. Each time a choice is made within the envelope's constraints, the mind practices patience, self-control, and foresight. Over time, these small exercises build resilience and confidence in financial decision-making. The act of respecting boundaries, even in small amounts, reinforces the sense of mastery over personal resources. Combine the envelope system with automation where appropriate. While cash is ideal for discretionary spending, recurring obligations like bills, rent, and loans can still be automated. This hybrid approach preserves control where it matters most, while freeing attention from predictable, repetitive tasks. The envelopes focus mental energy on discretionary decisions, which are often the most prone to impulsivity and error. Balance between automation and tangible allocation maximizes both freedom and discipline. Use envelopes as a visual teaching tool. The depletion of cash provides immediate feedback. You see the impact of choices clearly, and the consequences of overspending are tangible. This method bridges abstract planning and real-world behavior, reinforcing lessons that digital-only systems sometimes obscure. Learning comes not just from numbers on a screen, but from the physical interaction with money, the deliberate act of allocating and spending, and the visible results of conscious choice. Plan for irregular or seasonal expenses with specialized envelopes. Gifts, repairs, holidays, and medical costs often disrupt monthly budgets. Create envelopes specifically for these categories and contribute regularly, even in small amounts. This foresight prevents unexpected costs from eroding daily spending or savings and reduces stress. The envelope becomes a tool for both discipline and preparedness, turning uncertainty into manageable structure. Regularly reconcile envelopes with actual expenditures. At the end of each week or month, review each envelope's activity. Note surplus, shortage, and adherence to the plan. Adjust allocations for the following cycle based on insights gained. This feedback loop reinforces awareness, strengthens habits, and ensures continuous improvement. The system remains flexible yet disciplined, responsive yet controlled. Data drives refinement, and reflection converts experience into actionable wisdom. The envelope method encourages intentional spending, aligned with values. Choices are deliberate. Every dollar leaving an envelope represents a decision that can be evaluated for necessity, alignment with priorities, and long-term goals. Mindless consumption is replaced by conscious action. Patterns of waste are exposed, and opportunities for redirection are illuminated. This approach builds both financial prudence and character, reinforcing self-mastery through tangible, everyday actions. Psychologically, envelopes reduce stress and decision fatigue. When limits are clear and resources are allocated in advance, the mind is freed from constant calculation. Daily choices become simpler because boundaries exist. The system provides structure without eliminating freedom. Knowing that money for essentials, goals, and discretionary spending is available in controlled amounts fosters calm, confidence, and intentional living. Discipline emerges naturally from clarity rather than coercion. Over time, the envelope system scales. More categories can be added as needed, new goals can be funded, and allocations refined. The method grows with life's complexity without losing simplicity, because each envelope maintains its purpose. Discipline becomes habitual, awareness deepens, and financial control becomes second nature. The tactile practice of allocation instills lessons that transcend money, cultivating patience, strategic thinking, and deliberate action in all areas of life. Start with a small number of envelopes to build momentum. Choose key discretionary categories and allocate funds according to realistic budgets. Engage fully with the process. Spend consciously, track carefully, and reflect regularly. Gradually expand the system as habits solidify. The envelope method is not about restriction. It is about empowerment, awareness, and control. Each envelope is a tool for creating structure, ensuring resources align with intentions, and teaching the discipline required for long-term financial stability. The power of envelopes lies in their simplicity, visibility, and enforceable boundaries. They make abstract planning tangible, reduce cognitive load, and foster disciplined behavior. Each interaction, filling, spending, adjusting, and reflecting, reinforces the principles of foresight, intentionality, and control. By combining physical allocation with thoughtful monitoring, envelopes transform money management from a source of stress into a daily practice of awareness, responsibility, and strategic living. The system is both practical and deeply formative, creating habits that sustain financial stability and personal growth over a lifetime. Number 7. Review finances. Every Sunday, a quiet opportunity exists, a chance to pause, reflect, and gain clarity over the past week. The act of reviewing finances weekly is not about obsession with numbers or creating stress. It is about cultivating control, insight, and foresight. Money is not simply a means of exchange. It is a reflection of choices, priorities, and discipline. By dedicating a regular moment to review, every dollar gains context, every habit reveals itself, and decision-making becomes deliberate rather than reactive. Sunday offers the perfect cadence for this practice, bridging the past week with the one ahead, creating continuity and establishing a rhythm that reinforces mastery over personal resources. Begin by gathering all financial information from the preceding week. Bank statements, credit card transactions, bills, receipts, and digital payment histories all belong in this review. Physical and digital sources must be reconciled to ensure no detail is overlooked. The process itself develops awareness, patterns, leaks, and opportunities become visible in ways that casual observation cannot reveal. Each transaction, no matter how small, carries information about behavior, priorities, and alignment with goals. Missing or ignored details are the seeds of financial chaos. Recognition is the first step toward discipline. Categorize transactions carefully. Separate essential spending, discretionary purchases, debt obligations, savings, and irregular expenses. This organization allows trends to emerge and informs whether the week aligned with intentional goals. Clear categorization transforms the abstract movement of money into tangible patterns, highlighting both strengths and areas for improvement. When the mind sees patterns, choices become strategic rather than impulsive. The act of categorization reinforces accountability and sharpens awareness, turning passive observation into actionable insight. Next, reconcile all accounts. Ensure that balances match transactions and that no unauthorized charges or overlooked bills exist. This step prevents errors from accumulating and allows early detection of discrepancies. Reconciliation is more than bookkeeping. It is an exercise in responsibility and foresight. Each successful match strengthens confidence in the system and confirms that control is being exercised, not as a precise understanding of balances is the foundation for deliberate planning and informed decisions. Evaluate progress against goals, savings targets, debt reduction plans, investment contributions, and discretionary spending limits all require review. Compare actual results to intended outcomes, noting areas of alignment and deviation. Reflect on why discrepancies occurred. Did unexpected expenses arise, or were spending choices misaligned with priorities? This reflective practice converts raw data into lessons. Awareness without reflection is incomplete. Insight comes from asking why results differ from expectations and what adjustments can be made. Highlight patterns and anomalies. Small trends, repeated overspending, or recurring underutilization of allocated funds are all meaningful signals. They reveal habits that may require correction, reinforcement, or adaptation. Anomalies might indicate errors, missed transactions, or changes in circumstances. Recognizing these signals promptly allows for proactive intervention rather than reactive scrambling later. Patterns provide a map. Anomalies are signposts directing attention to areas that require immediate action or adjustment. Set one corrective or enhancing action for the upcoming week. Identify a single focused step that improves financial alignment, whether it is transferring additional funds to savings, adjusting a discretionary category, negotiating a bill, or reducing a recurring expense. Limiting action to one primary focus ensures follow-through, prevents overwhelm, and builds momentum over time. The accumulation of these small, intentional actions compounds into substantial financial and behavioral improvements, reinforcing the value of consistent, disciplined reflection. Visual tracking enhances insight. Charts, graphs, or simple ledgers can illustrate income versus spending, cash flow trends, or progress towards specific goals. Visual representation turns abstract figures into comprehensible information, making patterns and deviations immediately apparent. The brain interprets visual cues faster and more accurately than raw numbers, allowing for intuitive understanding and quicker, better informed decisions. Seeing progress visually strengthens motivation and reinforces the discipline of the weekly review. Include future planning as part of the review. Examine the upcoming week's obligations, expected income, scheduled bills, and anticipated discretionary spending. Planning proactively allows for better allocation of resources, anticipates potential conflicts, and reduces surprises. The review is not solely retrospective. It is a bridge to intentional action in the week ahead. Preparing in advance reduces mental friction and ensures that choices are made from a position of knowledge rather than reactive pressure. Reflect on lessons learned from the week. Identify successes and areas for improvement. Celebrate the reinforcement of good habits, such as staying within budget or making a strategic payment toward debt. Acknowledge deviations without judgment and extract actionable insights from them. This reflective component transforms the review from a mechanical exercise into a practice of growth and self-mastery. Every week becomes a microcosm of continuous improvement, fostering both financial competence and personal discipline. Integrate this review with broader financial systems. If using envelopes, ensure balances align with expenditures. If automated payments are in place, verify that they executed correctly. If a command center exists, update data and dashboards to reflect the latest information. Coordination between systems ensures consistency, reduces errors, and strengthens confidence in financial control. The weekly review acts as a synchronization point, harmonizing disparate elements into a coherent whole. Anticipate challenges and prepare solutions. Each week may present unexpected expenses, changes in income, or other disruptions. During the review, identify potential issues and plan contingency. This proactive approach transforms uncertainty into manageable scenarios, reducing stress and enhancing resilience. Preparedness strengthens the system and reinforces confidence that financial stability is maintained, even in the face of unpredictability. Develop a mindset that treats the review as non-negotiable. Consistency builds habit and compounds results. Even if time is limited, a brief session to check balances, note anomalies, and plan one action maintains continuity. Discipline grows, not from occasional effort, but from the repeated exercise of intentional oversight. The reliability of the weekly review becomes a pillar supporting both immediate control and long-term progress. The review fosters a sense of accountability. Whether reported to oneself, a partner, or a financial mentor, documentation of weekly findings creates a feedback loop that reinforces responsibility. The act of recording observations, decisions, and progress transforms reflection into tangible evidence of engagement. Accountability amplifies the impact of discipline, converting intention into observable and actionable outcomes. Psychologically, weekly reviews reduce anxiety. Money is no longer an amorphous worry, but a visible, understood element of life. Problems are identified before they escalate, and success is acknowledged, producing confidence and calm. The ritual of review instills clarity, control, and focus, reinforcing a mindset that is both strategic and resilient. Emotional energy is preserved because uncertainty is replaced by actionable knowledge. Over time, the practice compounds. Weekly reviews create a continuous feedback loop. Patterns are recognized, lessons are learned, and decisions improve incrementally. Small adjustments accumulate into significant changes in savings, spending behavior, debt reduction, and investment growth. Discipline, foresight, and consistency become habitual, producing both tangible results and deeper self-mastery. The rhythm of Sunday reflection becomes a cornerstone of long-term financial stability. Begin with a defined routine. Choose a consistent time each Sunday to gather information, review transactions, reconcile accounts, analyze trends, and set one actionable priority for the week ahead. Protect this time as non-negotiable, even if brief, and gradually expand the depth of review as comfort and skill develop. Repetition fosters mastery, insight, and clarity, turning a weekly ritual into a powerful tool for financial control and personal growth. The act of reviewing finances every Sunday transforms both money and mindset. Each session reinforces awareness, accountability, and intentionality. Patterns become clear, progress is measured, and actions are deliberate. By committing to this weekly practice, control replaces chaos, confidence replaces uncertainty, and discipline becomes habitual. The simple, consistent habit of reflection builds a foundation of financial clarity and resilience that supports both immediate well-being and long-term success. Number 8. Cut expenses with clear rules. Every dollar spent carries weight. Each choice either strengthens financial stability or erodes it. Cutting expenses is not about deprivation or fear. It is about intentional alignment of resources with priorities. Without clear rules, spending becomes reactive, impulsive, and chaotic, and opportunities for growth or security slip unnoticed through gaps in habit. Establishing clear rules for reducing expenditures is a disciplined approach to reclaim control over finances. Rules create boundaries, guide decisions, and prevent the erosion of goals by small, repeated, often unnoticed expenditures. Clarity transforms restraint from a struggle into a structured, empowering process. The first step is awareness. Before eliminating expenses, understand where money flows. Track every purchase over several weeks, categorize it, and calculate patterns. Identify which expenditures are essential versus optional, which deliver long-term value versus fleeting satisfaction. Awareness uncovers habits, exposes inefficiencies, and highlights potential areas for reduction. Decisions grounded in data are effective, guesses are costly. Clear observation turns abstract frustration into actionable insight. Once habits are understood, establish explicit rules. Rules should be practical, measurable, and aligned with values. For example, limit dining out to a specific number of meals per week, cap discretionary spending, or avoid impulse purchases exceeding a predetermined amount. Rules provide structure. They define the acceptable range of behavior, removing ambiguity and second-guessing. When decisions are guided by predefined parameters, energy is preserved, and discipline becomes automatic, rather than a constant negotiation with willpower. Automate adherence where possible. Set up alerts, budgeting software, or digital trackers that notify when thresholds are approached or exceeded. Automation does not replace judgment, but reinforces rules by reducing the chance of oversight. Real-time feedback ensures that small deviations do not accumulate into larger problems. A combination of explicit rules and automated reinforcement transforms intentions into reliable action. Apply a principle of prioritization. Not all expenses carry equal importance. Rank expenditures based on necessity, contribution to long-term goals, and alignment with values. Essentials like housing, utilities, and transportation take precedence, while non-essential spending is evaluated critically. This hierarchy guides decisions when compromises are necessary, ensuring that reductions occur in areas of least impact to well-being. Prioritization transforms sacrifice into strategic choice rather than random limitation. Incorporate the concept of waiting periods. For discretionary purchases, enforce a mandatory delay before committing. Waiting 24, 48, or even 72 hours creates space to evaluate necessity, alternative options, and potential consequences. Often impulses dissipate, revealing which purchases were truly desired versus momentary cravings. This rule diminishes regret, reduces waste, and fosters deliberate consumption. Patience is a tool for both financial discipline and emotional resilience. Track and measure results continuously. At the end of each week or month, review expenditures in relation to established rules. Note adherence, deviations, and savings achieved. This tracking converts abstract goals into tangible evidence, reinforcing positive behavior and guiding adjustments. Accountability emerges from observation, patterns inform decision-making, and success becomes measurable rather than aspirational. The process cultivates a feedback loop where improvement compounds over time. Identify recurring or hidden expenses, subscriptions, automatic renewals, service fees, and convenience charges often consume resources unnoticed. Rules should address these systematically, cancel unused services, negotiate fees, and avoid automatic rollovers without conscious review. Transparency over recurring costs strengthens control, prevents silent erosion of funds, and emphasizes intentional allocation of resources. Awareness combined with proactive action ensures that money works for objectives rather than disappearing unnoticed. Set boundaries for lifestyle-related spending. Rules can govern discretionary categories, such as entertainment, clothing, dining, travel, and hobbies. Establish limits aligned with both income and goal. The act of defining acceptable parameters reduces the temptation to overspend and creates predictability. Boundaries make decisions simpler. When rules exist, choices are made with confidence rather than hesitation. Discipline becomes a framework supporting freedom, not a constraint imposed externally. Engage in cost-benefit evaluation. Before spending, consciously weigh the immediate pleasure against the long-term impact. Ask whether the purchase advances goals, aligns with priorities, or could undermine objectives. Clear rules guide this evaluation by creating thresholds. Purchases beyond defined limits require deliberate consideration. This practice cultivates intentionality and encourages prioritization, transforming money from a reactive tool into a vehicle for meaningful action. Encourage creative substitution. When rules restrict expenditures, identify alternatives that satisfy needs without excess cost. Cooking at home instead of dining out, exploring free community events, or repurposing items fosters resourcefulness. Rules do not eliminate enjoyment. They inspire innovation and discipline in achieving similar outcomes at lower cost. Smart substitution demonstrates that restriction can coexist with quality of life when guided by conscious intention. Implement the principle of one in, one out for discretionary items. When acquiring a new non-essential item, remove or forego another to maintain balance. This rule enforces mindfulness, discourages accumulation, and prevents passive expansion of spending habits. It instills a culture of evaluation rather than automatic consumption, reinforcing the concept that every resource has a purpose and finite boundaries. Prepare for exceptions with conscious planning. Some expenses will arise unexpectedly. Rather than abandoning rules entirely, build small contingencies or temporary allowances. A buffer enables flexibility without compromising overall discipline. The presence of a well-defined plan to accommodate anomalies strengthens adherence and ensures that one-off deviations do not derail broader objectives. Strategic flexibility preserves both structure and resilience. Reassess periodically. Rules should evolve in response to changing circumstances, income levels, and goals. Periodic evaluation ensures that boundaries remain relevant, realistic, and effective. Static rules that do not adapt risk becoming either overly restrictive or ineffective. Continual refinement transforms rules from rigid restrictions into dynamic instruments of financial mastery, responsive to life's complexities. Leverage the psychological effect of tangible limits. Whether using envelopes, digital tracking, or other visual cues, explicit boundaries create a sense of control. Clear rules reduce anxiety, prevent decision fatigue, and foster confidence. The brain responds to structure. When expectations and limitations are defined, mental energy is conserved for more strategic or creative tasks. Financial discipline becomes intuitive, reinforced by consistent, visible feedback. Connect rule-based expense management to long-term goals. Savings, debt reduction, investment, and future planning are the ultimate motivation for cutting costs. Rules are not arbitrary. They are designed to protect priorities and accelerate progress. By consistently following rules, small reductions accumulate into significant gains, compounding over weeks, months, and years. Each dollar preserved under the guidance of clear principles strengthens both financial security and personal agency. Begin with one clear, manageable rule today. Apply it consistently, track results, and adjust gradually. Layer additional rules over time, building a system that covers multiple categories while remaining simple and enforceable. Discipline grows incrementally, awareness deepens, and control becomes habitual. The combination of clarity, consistency, and conscious evaluation transforms expense reduction from a reactionary exercise into a sustainable, empowering practice. Cutting expenses with clear rules is a strategy rooted in foresight, intentionality, and self-mastery. Rules define limits, prioritize decisions, and guide behavior. They reduce stress, prevent waste, and amplify the impact of disciplined choices. By implementing, monitoring, and refining these rules, money becomes a tool for purpose rather than a source of anxiety. Over time, the practice cultivates both financial resilience and personal strength, producing tangible results and empowering habits that extend far beyond the immediate act of spending. Number 9. Plan cash flow before spending. Money is energy in motion, constantly moving between income, obligations, savings, and discretionary spending. Without a clear map, cash flow becomes unpredictable, and even well-intentioned plans can unravel. Planning cash flow before spending transforms uncertainty into control, allowing every dollar to serve a purpose. It is the practice of intentional foresight, deciding in advance where funds will go, which obligations will be met, and how priorities will be honored. This approach eliminates the stress of reactive financial decision-making, prevents surprises, and ensures that resources are aligned with both immediate needs and long-term objectives. Begin by understanding your income cycle. Identify every source of cash inflow, whether it is a regular paycheck, freelance payment, dividends, or irregular side income. Note not only amounts but timing, when funds become available for use. Clarity about the timing of cash inflow is essential for planning, because money that is physically or digitally present can only be spent once it is accessible. Awareness of cycles prevents overcommitment and allows for realistic allocation toward obligations, savings, and discretionary needs. Next, map all fixed and essential expenses. Housing, utilities, transportation, insurance, and debt obligations form the backbone of financial responsibility. List each with amounts and due dates. The goal is to ensure that obligations are fully covered before discretionary spending begins. By accounting for essentials first, you create a safety net that guarantees critical responsibilities are never overlooked. Planning cash flow around these priorities is an exercise in discipline and foresight, establishing a foundation of security and confidence. Include irregular or variable expenses in the plan. Grocery bills, medical costs, fuel, and seasonal obligations fluctuate week to week. Estimate realistic amounts for these categories, incorporating historical data or projected averages. Assign funds to cover these expenditures before considering discretionary purchases. Predicting variability prevents shortfalls, reduces stress, and ensures that spending does not erode necessary resources. Planning for irregularities transforms uncertainty into manageable structure. Integrate savings into cash flow planning. Treat saving as an intentional expense, not residual leftover. Decide the amount to allocate toward emergency funds, investments, retirement accounts, or specific goals before any discretionary spending. This proactive approach ensures that long-term priorities are met consistently, even if unexpected expenses arise. By treating savings as a non-negotiable component of cash flow, financial stability becomes a built-in habit rather than a chance outcome. Break the month into smaller periods if necessary. Weekly or bi-weekly planning can create a more granular understanding of resource allocation, allowing for better monitoring and course correction. Divide income and obligations across these periods, ensuring that essential and priority spending is always accounted for before discretionary choices. Granular planning prevents surprises, reinforces discipline, and cultivates a rhythm that strengthens control over both short-term and long-term financial outcomes. Forecast discretionary spending consciously. Only after essential obligations and savings are secured should you consider discretionary purchases. Identify categories such as entertainment, dining, hobbies, or travel, and assign specific amounts to each. Planning these allocations in advance reduces impulse spending, provides clarity on limits, and allows choices to be made with intentionality. Each discretionary decision is then evaluated against a framework, rather than made in reaction to momentary desires. Visual tools enhance comprehension. Use spreadsheets, budgeting software, or even simple charts to map inflows and outflows, track obligations, and monitor discretionary allowances. Visualization transforms abstract numbers into an actionable map, seeing when funds arrive, when obligations are due, and when discretionary spending is permissible, makes decision-making intuitive and precise. The clarity reduces mental load and strengthens confidence in executing financial plans effectively. Anticipate timing conflicts. Align cash inflows with obligations to ensure that sufficient funds are available when needed. If bills are due before income arrives, plan transfers in advance or maintain small buffers to cover gaps. Anticipating timing mismatches eliminates stress, prevents late fees, and ensures that discipline is maintained without compromise. Cash flow planning is as much about timing as it is about allocation, and awareness of both is essential for mastery. Review and adjust weekly. Even with careful planning, reality often deviates from projections. Track actual spending, note differences, and refine the plan accordingly. Identify overspending, underutilization, or unforeseen expenses, and make conscious adjustments for the following periods. Continuous feedback transforms planning from a static exercise into a dynamic system that grows stronger with each cycle. Discipline is reinforced through observation, reflection, and proactive correction. Include contingency planning. Unexpected events, a car repair, medical expense, or urgent travel are inevitable. Allocate a small portion of income toward a flexible buffer or emergency envelope. Planning for these contingencies prevents disruption to both obligations and savings, reducing stress and reinforcing the predictability of cash flow. Preparedness transforms potential crises into manageable deviations rather than destabilizing events. Prioritize goals within cash flow planning. Not all priorities are equal. Debt repayment, emergency fund growth, and long-term savings should be elevated above non-essential purchases. Assign higher priority to obligations that compound future stability or security. By embedding priorities into planning, decisions become strategic rather than reactionary, reinforcing long-term vision over short-term gratification. Each allocation reflects a conscious choice about what matters most, ensuring that resources align with intention. Implement rules for discretionary adjustments. If unexpected opportunities or needs arise, adjust spending consciously by reallocating funds from lower priority areas rather than overspending. Rules maintain control while providing flexibility. Each adjustment becomes a deliberate decision, reinforcing awareness and preventing erosion of stability. Conscious reallocation strengthens judgment and encourages intentionality in all spending decisions. Engage in scenario analysis. Consider potential income fluctuations, unexpected obligations, or seasonal costs, and simulate how cash flow would respond. This practice develops resilience and preparedness. Understanding the effects of various scenarios allows for informed decisions and creates confidence that the plan can withstand minor disruptions. Anticipating possibilities rather than reacting to them enhances control and reduces anxiety. Plan for psychological reinforcement. Cash flow planning is not merely mathematical. It is also behavioral. Visualizing progress toward goals, seeing obligations covered, and anticipating discretionary allowances creates satisfaction and motivation. Positive reinforcement strengthens adherence to planning, making discipline habitual rather than burdensome. The mental clarity gained from deliberate cash flow planning reduces anxiety and increases both confidence and focus. Integrate planning with other financial tools. Envelopes, automated payments, or a financial command center can complement cash flow planning. Allocate funds to envelopes according to forecasted spending, automate transfers to savings, and update dashboards to reflect planned versus actual movement. Coordination between planning and execution ensures that intention aligns with reality, reinforcing discipline and maximizing efficiency. Start small, then scale. Begin by planning cash flow for 1 week or 1 month, capturing all inflows and obligations, and forecasting discretionary spending. Implement the plan, monitor adherence, and refine continuously. As familiarity and confidence grow, expand the planning horizon to include multiple months, seasonal obligations, and long-term goals. Incremental development ensures accuracy, reduces overwhelm, and embeds discipline into routine practice. The act of planning cash flow before spending transforms financial management into a proactive practice. Each dollar has a purpose, every obligation is met, and discretionary spending is deliberate. Predictability replaces chaos, insight replaces confusion, and control replaces reaction. Over time, this practice builds both tangible results, savings, stability, reduced debt, and intangible qualities, discipline, foresight, and resilience. Cash flow planning is not merely a budgeting exercise. It is a framework for intentional living, a structure that supports both immediate security and long-term success. Number 10. Set financial goals deadlines. Financial goals without deadlines are like a ship without a rudder, directionless and vulnerable to drift. Setting deadlines transforms abstract aspirations into tangible targets, creating urgency, focus, and accountability. A goal without a timeline remains a wish. A goal with a deadline becomes a plan of action. Deadlines are not about pressure. They are about clarity, discipline, and structure. They provide a framework that aligns daily actions with long-term objectives, ensuring that every decision contributes purposefully toward the desired outcome. By combining ambition with time-bound targets, financial goals become achievable rather than theoretical, and progress becomes measurable rather than abstract. Begin by defining precise goals. Clarity is essential. Vague objectives like save more or reduce debt lack power because they offer no measurable endpoint. Instead, specify exact amounts, targets, or achievements. Examples include saving $10,000 for an emergency fund, paying off $5,000 in credit card debt, or building a retirement account to a set balance. The precision of these goals allows planning to be actionable, enabling every step to be evaluated against a concrete metric rather than intuition. Measurement transforms intention into accountability. Next, assign realistic deadlines. Each goal should have a specific time frame that is challenging yet attainable. Deadlines create a sense of urgency and structure, converting a distant aspiration into a series of manageable milestones. Consider income levels, obligations, and potential unexpected expenses when establishing timelines. Unrealistic deadlines lead to frustration, while overly lenient ones reduce motivation. Thoughtful calibration ensures that the deadline serves as a motivator and organizer rather than a source of stress. Break larger goals into smaller milestones. Ambitious objectives can feel overwhelming without segmentation. Divide them into incremental steps, each with its own short-term target and time frame. For instance, if the goal is to save $12,000 in a year, establish monthly or bi-weekly milestones of $1,000. These smaller markers provide continuous feedback, celebrate progress, and maintain motivation. Incremental achievements transform long-term goals from intimidating abstractions into manageable, concrete action. Integrate goals into daily and weekly routines. Financial deadlines are effective only when supported by consistent behavior. Incorporate actions such as automated savings, discretionary spending limits, or debt repayments aligned with timelines. Regular engagement ensures that the pathway toward each goal remains active and visible. Daily and weekly alignment bridges the gap between intention and achievement, transforming aspiration into habitual practice. Visual representation strengthens commitment. Charts, progress bars, or graphs illustrating target completion reinforce awareness and motivation. Seeing a visual representation of advancement toward deadlines provides both accountability and encouragement. Progress becomes tangible, and motivation is reinforced by concrete evidence of effort translating into results. Visualization bridges the psychological gap between current reality and desired outcomes, making goals feel both attainable and real. Prioritize goals strategically. Not all objectives carry equal urgency or long-term impact. Rank goals based on necessity, potential return, or alignment with values. Essential goals such as debt elimination or emergency fund accumulation may take precedence over discretionary objectives. Prioritization ensures that effort and resources are allocated where they produce the greatest benefit, preventing diffusion of energy across too many simultaneous targets. Deadlines reinforce focus on high-priority objectives, making progress deliberate rather than scattered. Anticipate challenges and plan contingencies. Deadlines introduce accountability, but life is unpredictable. Unexpected expenses, fluctuations in income, or unforeseen circumstances can disrupt progress. Integrate buffer periods, adjust allocations, or temporarily modify goals while maintaining overall direction. Preparedness ensures that challenges do not derail progress and reinforces resilience. Deadlines paired with thoughtful contingency planning transform obstacles into manageable deviations rather than catastrophic failure. Reinforce goals through accountability. Share progress with a partner, mentor, or trusted advisor, or maintain a personal log of milestones achieved and adjustments made. External or self-imposed accountability encourages consistent adherence to deadlines and provides feedback loops that enhance focus and discipline. Reporting progress transforms abstract commitment into observable action, increasing the likelihood of completion. Evaluate results periodically. Establish routine reviews to assess progress toward each goal. Examine completed milestones, identify obstacles, and adjust strategies if necessary. Reflection ensures that the path toward deadlines remains viable and aligned with reality. Evaluating performance strengthens decision-making and provides insight into both effective practices and areas requiring refinement. Continuous assessment fosters a dynamic process rather than a static plan. Balance ambition with feasibility. Deadlines should push behavior and focus attention without creating unnecessary strain. Unrealistic targets can induce frustration or burnout, while overly conservative deadlines fail to maximize potential. Thoughtful calibration encourages growth, maintains motivation, and fosters consistent, deliberate action. Each deadline is an opportunity to stretch capability within a manageable framework, cultivating both discipline and confidence. Connect goals to intrinsic motivation. Beyond numbers, each financial objective should reflect deeper values or priorities: security, freedom, independence, or the ability to pursue meaningful opportunities. Deadlines become more compelling when tied to purpose, transforming them from arbitrary dates into milestones in a larger vision. Motivation rooted in personal significance increases adherence, resilience, and the quality of engagement with financial discipline. Integrate deadlines with cash flow planning. Ensure that income and spending cycles align with timelines for savings, debt repayment, or investment accumulation. Planning cash flow in conjunction with deadlines transforms abstract timeframes into practical action steps, linking intention with execution. Synchronization between timing and resources prevents delay, enhances efficiency, and ensures consistent momentum toward achieving targets. Celebrate incremental achievements. Each milestone reached provides feedback, motivation, and reinforcement. Recognizing progress reinforces discipline and builds confidence, while failure to acknowledge success can erode motivation. Celebrations need not be extravagant. Even small acknowledgement of accomplishment strengthens engagement, validates effort, and reinforces the psychological benefits of structured goal setting. Adapt as circumstances evolve. Deadlines should be flexible to accommodate changing priorities, unexpected challenges, or revised goals. Adjustments should be conscious, deliberate, and recorded to maintain continuity and accountability. Flexibility ensures that goals remain relevant and achievable, transforming deadlines from rigid constraints into adaptive tools that guide action while respecting reality. Commit fully to the process. Setting goals and deadlines is insufficient without consistent action. Each decision, allocation, and choice must be evaluated in light of the deadline. Daily awareness of targets, milestones, and progress embeds discipline into habitual behavior. Commitment transforms potential into reality, turning aspiration into tangible achievement. Deadlines act as anchors that orient effort, energy, and resources toward measurable outcomes. The combination of clarity, time-bound targets, and consistent action produces compounding results. Small, deliberate steps accumulate, accelerating progress toward larger objectives. Deadlines provide structure, foster accountability, and maintain momentum. Each day, week, and month contributes incrementally to achieving goals, creating a trajectory of disciplined growth and financial mastery. The structure of deadlines transforms otherwise diffuse effort into measurable, impactful outcomes. Implement a feedback loop. Review progress against deadlines, refine strategies, and adjust milestones as necessary. This iterative process ensures continuous alignment with priorities, realistic pacing, and achievable results. The cycle of planning, action, reflection, and adjustment reinforces learning, strengthens discipline, and builds confidence that objectives are attainable. Deadlines become not static endpoints, but integral elements of a dynamic, evolving system of growth. Ultimately, setting financial goals with deadlines converts intention into action, ambition into measurable achievement, and vision into reality. Deadlines focus attention, structure effort, and reinforce discipline. They transform abstract aspirations into concrete pathways, ensuring that every financial decision aligns with both immediate needs and long-term objectives. By integrating clarity, measurable targets, realistic timelines, and consistent review, deadlines provide the structure necessary for lasting success. Goals without deadlines remain wishes. Goals with deadlines become milestones on the path to mastery, security, and purposeful financial freedom.